Thank you for being with us once again, and for your time and your patience. I appreciate it. Let me start by echoing the comments of Senator Grassley. I want to compliment you on the decision you've taken to enhance the transparency of the Fed's activity and operations. I know you've put a lot of thought into this and advocated this for a long time. I have long shared your view that it's better for our economy, it's better for everyone involved if the Fed does operate with greater transparency. Specifically, I like the fact that you have articulated an inflation target. We could have long and interesting discussions about exactly what that should be, but the fact that you're specifying a number I think is very constructive, and so I want to thank you for that development. I want to talk a little bit about the dual mandate that you have to contend with, and then these combined simultaneous objectives of promoting full employment and maintaining price stability. You've said, I think, if I have it right, that the Fed, essentially through monetary policy, can control inflation over the long run, but cannot control unemployment over the long run. Is that a fair characterization?
Yeah, yes.
Right. So the thing that I'm concerned about, and I'm not asking you to criticize the dual mandate. I know you're going to live with the law of the land as it applies to you, and I fully understand that. But isn't there a real possibility that these objectives will at some point not be complementary? In other words, it seems to me very likely, for instance, that the unemployment rate is going to stay above the optimal full employment level for a number of years. And it also strikes me that at almost any time inflation could kick up above the targeted level that you've set. It has very recently. It could, as I say, at almost any time. If that were to happen, it seems to me you have this tension between these two simultaneous objectives. You've described quite sensibly that you would take a balanced approach to dealing with this. Mm-hmm. But doesn't that necessarily mean that in that scenario where unemployment remains persistently high and the inflation rate kicks up above the target, wouldn't you necessarily have to back off that targeted level or pursue a policy that would tolerate higher inflation than your own target?
So again, you know, this of course is a dual mandate oriented approach, as you understand, and we thought the main benefit of being clear was to provide more information about what our long-run objectives were, to give more quantitative information about that. The situation you're describing, just to be clear, is hypothetical. It's not currently the situation. Inflation looks to be at or near target.
This precise moment, yes.
We do not, let me be clear about one thing. We're not going to seek higher inflation in order to advance unemployment. It's possible that, you know, because we don't control in the short run perfectly, obviously, inflation, unemployment, that you could have shocks that would drive both objectives away from their target, and in which case, in a very symmetrical way, we would be returning both parts of the mandate towards the target, but we'd have to take account of the other part of the mandate. So, you know, it could affect the speed at which we return inflation to target, but by the same token, if inflation is high, it could affect the speed at which we return employment to the target. So there would have to be some interaction of those two things, and it's fully balanced and symmetrical in that respect.
That's roughly what I thought you'd have to say. Let me try a different approach. It seems unlikely to me, anyway, that the Fed would pursue such an extremely accommodative monetary policy as it has been pursuing and is pursuing if it weren't for the employment mandate. I'm concerned about some of the unintended consequences of maintaining zero interest rates, negative real interest rates. And I wonder if you'd comment on some of these. When I just think about some of the implications. We have savers are being punished for this at least twice. Once by virtue of the fact that after sacrificing their whole life to accumulate savings, they get no return. And then the very real possibility that the value of those savings will be eroded. Secondly, we're encouraging excessive risk-taking. Thirdly, it seems to me this drives a misallocation, certainly has the potential to drive a misallocation of investment, and I would argue the risk of creating bubbles In fact, it's hard not to see the U.S. Treasury market as a bubble right now. And lastly, doesn't this enable the excessive deficits that we're running here, in part because they're funded at artificially low interest rates? So these are some of the concerns that I have from this policy, and I wonder if you'd just comment on them.
I don't know if I can cover all of them. Let me just first say that there are single mandate central banks like the Bank of England and the ECB, which have policies very similar to the Fed. Given that inflation is close to target, I don't think we would be doing radically different things if we had a single mandate at this particular point in time. We are quite aware of these costs and risks. I've talked about them in speeches, and it's one of the reasons that we discuss the efficacy and the risks associated with the policies as part of the overall discussion. With respect to, say, savers, for example, it's true that low interest rates reduce the return that savers get on their saving, but I would make the general point that savers just don't necessarily hold, say, Treasury bonds. They also hold corporate debt and stocks and a variety of other securities, and the returns on those securities depend very importantly on the strength of the economy. So by trying to strengthen the economy, we're helping to improve the returns to savers. To some extent, on risk-taking, to some extent, part of the reason for the policy is to move people away from very conservative liquid positions slightly more into riskier positions that involve investment and lending and so on that would help promote strength in the economy. We don't want to go too far, and we are very attentive to that, and we have greatly expanded our ability to monitor the financial system and to watch out for problems and to try to address them. And I've been in many conversations with with insurance companies, pension funds, and so on. On this allocation, we're trying to get the economy back to a more full employment situation. When you're this far away from full employment, it's not obvious that the investments that are being made are the right investments. They may be insufficient, for example, because there's not enough demand for product. And I guess the last comment I would make, well, you've asked me before about deficits, and I understand that concern, but I think that the effects of Fed policy, independent of all the other factors on Treasury rates, is modest. And in any case, rates will rise eventually. And if investors were to lose confidence in U.S. federal fiscal policy, there's nothing the Fed could do to prevent those rates from rising. So I trust that Congress will understand that independent of the Fed's policy here, which is aimed at strengthening the economy, which also helps deficits, that it's extremely important to be looking ahead and making appropriate plans for stabilizing the deficit. So I'd be happy to talk with this at some other time more length if you'd like.